Hello traders, Steven Arpan here, founder of Master the Markets, Elite Traders Conference and the Traders Open Day. So today's topic is going to be on the 80% probability bar patterns, okay? Really very good stuff for you because it will give you a very strong edge in the market if you know how to apply these concepts into market conditions. Okay, let's start, right? So in the beginning I've drawn over here is like two vertical bars, right? Let me just take you one step behind so that you can understand how we actually get these two vertical bars, right? So for example, most of you will be very familiar with old Chelsea bars. So old Chelsea bars basically have got a high and a low, right? A high and a low. And most importantly, they have an open on the left hand side of the bar, and then finally the close on the right hand side. Most of you is so familiar with this. Now, if I were to remove the close and the open of the bar, then I would just get just the vertical bar alone, right? That's how we end up with these vertical bars. And that's what you're seeing over here with two vertical bars over here with the opens and closes being removed, okay? So that's what we have over here. Now here's a question for you traders, right? Before I start to explain more about this and all that, is what I want you to think about is if you were to make some patterns out of these two vertical bars, how many patterns can you form? Removing those patterns with equal highs and equal lows. So using these two bars alone, just vertical bars only, how many patterns can you form removing equal highs and equal low patterns? So just pause this video here for a while and just give it a go. Just get a blank piece of paper, just draft it out and see how many patterns can you actually form. Right, now, since you have had a go right now, so let's have a look on how these bar patterns actually can form. So let me give you the first one, right? And the first one would be one like that, where you have, out of these two vertical bars, you've got higher highs, right? And higher lows, yeah? So that's bar pattern number one. Bar pattern number two is going to be something like this, right? So lower lows and lower highs. Finally, the third pattern is going to be an insider bar, right? Where the bar is engulfed by the previous bar, where its high and low is engulfed by the previous bar. That's an insider bar, right? And finally, then we have an outsider bar. So where that outsider bar engulfs the previous bar with its high and low, further higher, with the high being higher than the previous bar and the low being further lower than the previous bar, okay? So these are the four bar patterns that you can form out of this two vertical bars, right? So let's move on further and see how we can actually correlate all this and build our edge, yeah? So out of these four bar patterns, the first two bar patterns is what we say correlate with market momentum, right? Which is this one over here, right? Market momentum. The next two bar patterns, traders, is to do with market compression. Okay, is where the market is basically contracting into, let's say, like, you know, in a kettle, right? It's just contracting before it bursts out. Now this is already, there is momentum in the market in terms of the bar patterns we're just talking about. Right, so now knowing this, market compression or market momentum, immediately you'll be able to see that once a market starts to contract and compress, what usually follows is an upthrust movement or a downtrust movement, which is basically large moves. So you can easily then start to think, which is you will have really large reward to risk moves at that particular junctures of the market. So you can then capitalize it and take advantage of those kind of positions and price pattern setups in the market. So I'll let you actually go and take a look in the market when you have time, especially spend some screen time, very critical, and go and identify these patterns and see how you can actually build an edge and build a strategy around it as well. In fact, the blog video that I think might be already down, maybe might be putting in the future, on how to build a strategy can help you as well in building one around these bar patterns. Now, in terms of percentages, right? So this is very important here, right? You'll be very keen to know that. Now, in terms of this market momentum, right? In terms of percentages, this higher highs, higher lows happens 40% of the time. Lower lows, lower highs happen another 40% of the time. And finally, market compressions happen 10% each of the time. Okay, so what we actually have then is market momentum happens 80% of the time. Market compression altogether happens 20%. Now, traders, these percentages are very, very useful for you definitely to build an intraday strategy, right? Knowing that these bar patterns happen 80% of the time and that only happens 20% of the time can be very, very useful. And even though this happened just only 20% of the time, but to know that after a market compression, they really burst out into large moves can also be very useful for you to build high reward to risk strategies that where you get out of the market just within a few days, right? Or even within that day itself if you want to program and if you want to put a strategy rule around those kind of exits where you just exit within that day as well, intraday trading, right? Cool. The final thing I do want to mention about these power patterns is that, let me just tell you this. If you were to look into the open, high, low, close, OHLC bar, and if you were to remove the opens and closes, and you look at two bars like this, right, the total number of patterns that you get is 4. Basically, it's 2 to the power of 2. However, if you were to include the opens and closes, so therefore I include, let's say, opens and closes over here, and let's say I do that, let's say I just remove that over there, high, there's open over there, and then a close. So you got a higher high and a higher low, right? So in coming into this 40% of the time occurring. Now, if I include the opens and the closes, then this then increases to 2 to the power of 2 times 2 to the power of 2, right? And then what you then need to do is then times it again by 2 to the power of 2 and 2 to the power of 2. Basically, it is 2 to the power of 4 times 2 to the power of 4, because now you got 4 permutations in each bar, because you got 1, 2, 3, 4. So it's 2 and 2 patterns, 2 to the power of 4 times again 2 to the power of 4. That gives you basically 256 combinations, traders. That's what we are really looking at, 2 to the power of 8. Now, interesting enough, in terms of the quantified research that was done in the X-Files, kind of very similar kind of projects and all that kind of stuff, what they actually found is, out of these 256 combinations, out of these price projects that they did, right, price kind of research projects that they did, they found out out of these 256 combinations, only 16 of them had a strong edge, okay? 16 of them had a very, very strong edge. Now, I definitely want you to go back and really think on all the stuff that I just told you, just this point on how about these bar patterns and making you aware of them and how actually the probabilities of them occur and how to then basically then use them to build a profitable strategy is the things that you need to go and think on and look on in the market, right? So really some key information over here to help you build a strategy with a strong and a profitable edge. Traders, I believe this video has been really, really massively helpful for you. And as we always say, till the next time, stay disciplined, follow your trading plan, and keep trading like a master.